hotels, unless it's the right price. Okay, so I listened to the CEO of Marriott this morning on CNBC. I mean, they're still 80% off on revenues, right? And he doesn't see any real recovery anytime soon. So hotels at the right price, but you're not going to get them at the right price. Nobody's going to sell a hotel for 20 cents on the dollar. It's just not going to happen. So
unless they're
maybe
hugely distressed.
Yeah, but there's, right now they're just not going to do that because that would put so much stress on the banks. So the last thing anybody wants is a black eye on their books. Nobody wants non-performing notes or assets on their books. So they're going to be hesitant to start that process because that starts affecting their ability to borrow and to leverage, and their balance sheet starts looking pretty bad because they got to move those things. So there's a lot there in the next year. I don't think you're going to see any real distress in the CMBS markets this year. Next year is when we're going to see some of that pain start to work through because you got the shopping malls, you've got the hotels, and you've got office and retail. There's some serious issues out there right now. And what will more than likely happen, because what we've seen is the Fed and Treasury are going to step into that CMBS market somehow and re-stabilize that debt. So that's probably what's going to happen with a lot of that stuff.
So I guess just to summarize, you probably wait in anything related to retail, hospitality, the areas that are getting hit really hard because we haven't yet seen the real stress.
Yeah, unless it's a really good deal, and your business plan will work. So, but if you take that in the conversation of the business plan we just talked about, so if you can go out and buy 20 hotels at 50%, and you can hold and get through this so that when it does come back, well, you've got a huge value add there. But it's gotta make sense, but you don't go out and buy something now, based on, okay, in 6 months, we're going to be back at 70% of the revenues we were at. You just can't do that. You have to get it at the right price that makes sense for now, and then look at your business plan, 5-10 years down the road.
What are some indicators that investors should be looking for to determine when is the right time to get back in?
So the easiest thing to watch and the biggest thing to watch, up or down. So the number one thing you really need to know, and we just saw this recently, and I was saying it in 2009, okay, when I went through that, you need to know the top. The number one thing, the most important thing to know is the top. That's way more important than the bottom, because if you don't get out at the right time, you got nothing, right? So everybody's doing value add, they're doing something to maximize. So, I called the top of the market, early this year. Everybody I knew, I said, go to cash, go to cash. So it's kind of easy to spot the top. I think we're still kind of there in the markets. It's very interesting what's going on there. In real estate, with interest rates where they were and values where they were, I think we've been at a peak for the last year in real estate as well. And, the debt just can't get any cheaper on real estate. I think we're at a bottom from what we've seen. It just isn't going to get any cheaper. And for people out there listening and watching, the Fed rate and the interest rates that you see the Fed dropping have zero to do with mortgage markets. Okay, that's a different market. That's a standalone. They can name their price. Okay, if a lender wants to loan you money, then they'll stack basis points on top of the whatever rate they're following, whether it's London Index or Treasuries or whatever they're basing it on. They'll put whatever they want on it. They got to make money. So just because the Fed rate's low doesn't mean that interest rates on loans are low. So you want to watch interest rates. If interest rates start creeping up, the market's going to just come to a screeching halt. So you really want to watch that. And then it's supply and demand, right? So you want to know your market at a very intimate level. What is the supply? What's the supply of new product coming online? What's the supply of units in the market and, vacancies? What are the rents? Things like that. So interest rates, supply, demand, and population. So net migration, okay? You don't really need to worry about job growth, income growth, and all that, like all these different metrics that a lot of people look at. You can boil it down very simply to what area is growing. Where are people moving in and not moving out? You want net migration. So everything else, if you've got net migration, everything else kind of falls into place.